Welcome to Tate Talk Live. I think today is October 17th of 2022, and we've got a great show for us. Got a great panel. So let's start by saying hello. Phyllis Brookshire, hello. How are you?
I'm great. Hello. Glad to be with you guys today.
Absolutely. Absolutely. Stephanie Gossett, how are you, Steph?
I'm good. How are you, Gary?
We are good today. Mr. Bardot from the upstate of South Carolina and Highlands Cashiers.
Good afternoon. I am excited. This is going to be a great panel.
Absolutely. TJ, what's going on?
Happy Monday. It's good to be with you guys.
It is great. Today, we've got a great program planned. You know, we've talked about the marketplace returning to normal, and I got introduced, we got introduced to a new phrase called talk tracks. Back in the day, that was called a script and a dialogue. And we've all been talking about words matter. And we've all been talking about what does it really mean when the market returns to normal. And as the team that is sitting here today on Tate Talk Live spent some time 2 weeks ago discussing what's happening in the marketplace, we thought it'd be great to talk about all of the things that are out there, the things that you're hearing each and every day from buyers and sellers, the things that we're hearing every day from the media. We're going to talk about how we have an obligation to disarm and interpret the media. So we've got all kinds of questions. Remember, go into the chat. We want to answer any questions you have. So we are going to get started. And I'm going to start with Miss Stephanie Gossett. One of the real keys today is communicating with a seller about pricing. And so share with our viewers some of your observations over the past couple of months as you've dealt with real estate professionals and leaders about setting the right expectations in pricing and getting your home sold.
Right. So I think that a couple things. First, you know, we have to just the facts, right? It's not good or bad. It is what it is. So we have to walk in with the attitude of going to be honest with these folks. I'm going to share information about what is going on in the market and the market statistics as they present themselves. I can't be reluctant to show the sellers or even to tell them the consequences of listing too high in a market, in a shifting market, and what that could ultimately do to their bottom line. You know, it being more important than ever to price and position appropriately from day one in a market that is shifting, as we learned, you know, time and time again in past markets. So to the real estate agents, you know, you have to think about how, you know, if it feels to us like this market has shifted overnight, imagine what is going through the mind of a prospective seller who saw their neighbor get 20 offers on day 1/2 or day pre-1 and received 10 offers on their house plus and you know, sold for 50,000 over asking price. And so naturally they are not paying as great attention to the market, and the shift, which seems very extreme to us, can only be somewhat of a shock to them, most likely. So we want to, you know, be armed with the information that's going to help us paint a picture for what they're about to enter into so that they can make some really good business decisions on how to position and price the home. I mean, they may not even realize that positioning and doing all the things that Mark talked about in his recent webinar to spruce up the home and create the nice curb appeal and market it properly. They may not even realize that's important right now. They might be living, and when we say living in the past, I mean, we might just mean 2 months ago, not 6 months ago. So first is just, I think, a mindset shift that we have to make sure that we are guiding them through with good, accurate information. And then, I mean, the other part of it having super timely data because things are shifting rather quickly. You know, comps might not be as important 3 months ago, comps that sold 3 months ago, as what our current competition is right now. So maybe we shift gears in pricing and, you know, maybe we try to get the sellers to go with us to visit some of the competition. And, you know, maybe we pull a friend in and let's see what they would do, if we were priced at X, Y, or Z. I mean, maybe we look 5% over and 5% under, and what is out there that we're going to be up against, and that might be more important than actually what sold 2 or 3 months ago, in a shifting market. So a few of the thoughts off the top of my head.
So I think they're all outstanding. The one that resonated with me was we cannot be reluctant to tell the seller the truth. Now, that's a blinding flash of the obvious, but over the past 2 years, we've been able to go in and seller would say, can we try this? And we say yes, and all of a sudden they get it. And that kind of conversation about timely market data. So let me just throw it out to our other panelists. Anything to add about the conversations we have to have with sellers today to help them understand the marketplace that exists? Mark, Tony, or Phyllis?
So Gary, I feel really strongly that in this market, ranges are critically important. So when you walk into the seller, and let's assume that your CMA says it's 450. And in the seller's mind, they're thinking 475 because they're in the old world of always listed high because you're going to get multiple offers over list price anyway. So maybe we go in with a 450 to 475 range. And we say, look, if you're looking for a realistic prompt sale in a short period of time, you probably need to be on the lower end of this range. And if we want to kind of push the market and test it and maybe find a more unique buyer who really wants that house, let's be on the high end of the range. But what I love about ranges is it protects you as the realtor. If you get that low offer early on, it's still in the range. But heaven forbid that you lose the listing to the other agent who comes in more aggressive than you do.
Excellent. TJ.
Couple thoughts. One is I would beg everybody to show versus tell. So you really need to show visuals about what we're describing. Stephanie was talking about the market that's different from 60 days ago. Well, maybe provide 2 quarters of the shift in the visual to the seller so they can see the shift. One of the things we've done this 5 stats. The one stat of the 5 stats I think is becoming more critical is the number of showings. So that is definitely one visual that I would start talking more about because that sets a different expectation, because my neighbor did sell their house with 10 offers and they had 50 showings in the first 24 hours. Well, let me tell you what's happening now. And most of our MLSs have some good visuals around that. But I still think of Eddie Cash from Raleigh Glenwood, that when we had our agent panel a few months ago, he said, we got to price it right to begin with, and I want buyers to fight over your property. There have been a lot of sellers and agents for that matter who said, yeah, all right, let's just pretend the number's 300. Let's try 325. The seller's pushing and the agent goes, okay, let's try it. And we still get closer to that. I'm hearing out left and right in the field, that is not happening anymore. And so I think somebody said it, the pricing in the beginning, the critical stage is day one, not let's gamble for 1 or 2 weeks. You got to come out hitting it right in this market.
Yeah.
And,
So Tony,
and Gary,
yeah,
one thing I just want to piggyback on before we leave that topic from Tony, the showing statistics. Oftentimes, if you do a little research in your showing time report section, you can find that perhaps in that range that Mark was talking about, there are a whole lot more showings happening than in just a $10,000 increment right above it. So that could make all the difference. To your point, Tony, if we're going to try to show and demonstrate maybe why it might be more important for a seller who's got a little bit more urgency in the timeline to get sold, we could pull out that kind of a report and talk through the buyer pool segments right now that are out there. And then the other thing I just wanted to add is that when we're out there looking at property online, I think we have to bring back that conversation with our sellers that there's a strategy in pricing and consumer online behavior, because I don't want to price at 500 and 1,000 or 499. If I'm somewhere right there, I want to be aware of the $50,000 search engine segments that most buyers, look at. So if I'm a buyer looking 450 to 500, I might miss something, for example, priced at 449,999. Right. So those whole little strategies we used to talk about all the time, when getting buyers in the property was part of our job, like it is again, are probably things we need to work back into our vernacular.
So it's interesting, Stephanie, you just stole a line I was going to say, and that is,
Sorry.
we're talking about what we all used to do, right? So none of our conversation today is new. It's just new for the past 24 months. It's about, brushing off the skills that we haven't had to practice, but in 17, 18, and 19, we did. And I think it's just a matter of re-energizing ourselves to do those things. So Tony, before we jump off this, there's a couple questions in the chat we will get to, but Tony, you talked about the 5 stats. I know we've had a webinar on it. I just quickly remind the audience, the other 4, you talked about showings, the other 4 are?
We do, we talk about days on the market, so the speed in which the market's moving. We talk about the monthly supply of inventory, which is the number of houses on the market based on time, so that that's to me, the competition factor. There's list price to close price ratio. So are we list it, and then what is the percentage against the actual offer? The number of showings, and then house appreciation is the final one. And that's probably I think the most important stat in the last couple of years, although I think showings is now becoming more important, but appreciation is the mindset of most sellers that come in and they want all this money because they see the market so hot. In our webinar last time, Katrina, who couldn't be with us today, used the words which resonate with me, the deceleration of the appreciation. I know that's a mouthful, but she's spot on, because some people now are thinking, especially on the buy side, that we're going to go into depreciation, and we're not. We're just seeing a deceleration of the appreciation. And that's probably a whole nother topic, but that's the 5th one.
So it's a whole other topic, and it is my next question, and the question is coming to you. So that's perfect.
Okay.
So I think one of the things that is important is the media. We talk time and time again. What are the greatest challenges in our business? Inflation, interest rates, inventory. We believe to a large extent, it's the media today is maybe our greatest challenge. If you go on today, which I did, and probably many of you did, I read something like prices going into 2008, 2009 levels. Well, there's nothing true about that. Prices are declining month after month after month. And the issue isn't prices are going down, because they're not. It's virtually impossible for prices to go down when demand still outweighs the supply. It's economics 101. And so let's go back to Tony to what are the words we use? How do we explain to both buyers and sellers that the media is saying one thing, but the fact of the matter is much more, as Katrina had described in the webinar? What are the words that we can help our audience use? Because the buyer and seller are seeing the headlines.
Yeah, it's the clarify versus terrify, right? Well, a few things. So let's talk about the buy side. So most buyers probably we're dealing with are thinking the world's going to collapse, real estate's going to collapse, and it's the memories of 09. So what we have to do is, the simplicity in my mind is, we have been doing double-digit appreciation, and I think it's going to shift to single-digit appreciation. So it's not going to collapse. And one of the lines I use with the team is, how are you doing on your savings rate? You know, what are you earning on your savings account right now? The best one I've seen lately, by the way, is Ally Bank, who just started paying 2.25%. But if I can earn 6% to 7% to 8% on my investment in real estate, that's still going to outperform every market index that I'm aware of. You're not going to get 20% appreciation on your money right now, like we did the last year with real estate. But what if you got 8%? So there is an investment strategy for some people in their mindset to think this, I can't buy right now, I can't afford. Well, you can't afford not to. The other thing that I'm hearing over and over about the shift in this market with prices is that we're starting to see more price reductions. And I worry some days that the number of price reductions connects to depreciation, and it doesn't, but there are more opportunities, I think, is what are the words I would use with the agents. I heard one that I'm going to share with y'all yesterday. I heard a builder is accepting contingencies now. And I'm like, what? I forgot how to spell contingency. But it's starting to shift. So we're seeing some builders in the market looking at contingencies, accepting longer time. And the other thing is the speed in which this is gone, our buyers can slow down a little bit. But suddenly on that finance side, maybe you can get an adjustable rate. Maybe you can get the seller to pay the closing costs. Maybe you can get a seller to do a buy down. And I'm hearing, especially on the new construction in just the last 1 or 2 weeks, that these kind of financing opportunities are going to overcome some of this pricing issue that we've been dealing with. It's starting to shift that way.
It's interesting. We recorded a podcast this morning and we were asking the guest that same question. And she said in her conversation with a buyer is, number one, it's temporary, meaning that at some point in time in the future, if it's 7.25, there might be an opportunity to refinance. So it's temporary. And number two, unlike a rent, your expense or your cost is not appreciating. You're locking yourself in. We're going to come back to some of the other investment indices in a minute. That was one of the comments that Mark and I bantered back and forth a little bit, but I'm going to move over to Phyllis. She and I were talking today about data and the importance of market statistics. And she asked me a question. She said, are you familiar with these platforms that we have access to so that we can, as Stephanie said, be real time, know the information so that we can truly be the trusted advisor? So Phyllis, you want to share a couple of those that you shared with me this morning?
Sure. So one, Stephanie mentioned MLS, but within, I think almost all of our MLSs, maybe not every single one, but they have a tool called InfoSparks. And InfoSparks is an amazing way for you to really hone in on your specific market and get some really good data analysis. So you can do areas, you can do bedrooms, baths, you can do price points, but you can see both a long view and a short view. So it creates great graphs. You can actually send links out to the graphs. It's an unbelievable tool to me. And so I think really understanding it. So if you're getting ready to go out and you're going into Heritage and Wake Forest and you're going into $450 price point, which is probably $650 now, but that price point, you need to go in and you need to understand it and you need to watch the graphs and you need to be able to confidently educate and explain it to your seller or your buyer. Right. But you've got to arm yourselves and you really have to invest the time in making sure you understand the numbers. So InfoSparks is one. RPR, Realtor Property Resource, amazing amount of data, amazing amount, almost overwhelming, but get in there and start spending some time in it. So that's the really good. Obviously, you have MLS for your active competition, but this really gives you a little bit of a view. And then I think the other place is another place that's great for providing you some context for what the market's doing is Keeping Current Matters. So it's really good at giving you the 30,000 foot view. They have great charts on, what interest rates have done historically, what supply's done historically, what demand's done. And I think, as you tier your conversation down and you start 30,000 feet and then you talk a little more regionally and then you get specific, having all of that resources are good. But you can't do this 5 minutes before you're walking into an appointment. You should be dedicating time. I know the people on this call are doing it every weekend we are spending time going in and looking because the market's shifting that quickly, right? So go in, looking at it, listening to everybody on this call listened to Barry Habib over the weekend, who has an amazing explanation of market conditions. And so you just start listening and internalizing it. But that's the places. So InfoSparks, RPR, and then Keeping Current Matters are three great places to go get the data and really make sure you understand it. And if you need help understanding it, reach out to your branch leader or one of us, and we'll walk you through it the best we can.
Yeah, to that point though, Phyllis, real quick, that's a great idea. If you could, you said don't talk about this 5 minutes before. What would be really good is taking those visuals and putting it in a Moxie presentation and keeping an update. Send that link to your buyer or your seller and say, I want to talk about the market before we get into your stuff. I mean, keep educating the show and tell stuff. So you could use some of those dynamics in that.
Yeah, and I do think, Keeping Current Matters, part of their strategy is to just tell you what other people are saying, right?
Yeah.
To give some context. And I do think if they're hearing from other people besides you and they're reinforcing what you're saying. So I love that idea of put a Moxie presents to get together with understanding the current market and give it to your buyers or your sellers, ahead of time before you meet them. And then they have a chance to digest it before you, and then you can talk about it together. Because I think to Gary's point, like this is, and Stephanie too, this is a little bit of a shock now for people when you go in and you say, oh, we're not going to have 25 offers and we're not going to be, 100,000 over list price. So they need some time to process and digest it and not just react to our comments too.
Great. So I'm going to shift down to Mark Bardot. Two things. Number one, it's interesting about the timeliness and the keeping up to date with data. We had a panel down in the upstate, and if I remember correctly, one of the comments was exactly what you guys have just said. Don't know the data for your presentation. Know the data and the market statistics every minute of every day, because you don't know when you're going to run into somebody who's going to ask you that question about the marketplace, but it's not in preparation for a listing presentation or a buyer consultation. It's going to the grocery store on a Saturday morning. And that was one of, Mark, you saw my 87 takeaways. Really that is so important today, because whether it's Saturday this week or Saturday next week, it is a moving target. So as we prepared for today, each of our panelists sent a couple of questions. So I'm going to throw Mark Bardot a question back, and then I'm going to give you a little bit of data. How well has the value of your real estate asset and or assets compared to your stock? So I did a little homework today. Any of my friends who are financial advisors are not going to be pleased with Tate Talk Live. However, it's about knowing the numbers. NASDAQ year to date down 34.03%. The S&P 500 down 23.87%. Dow Jones down 17.13%. Fixed income, U.S. aggregate bond down 15.84%. Global bond index down 21.34%. What we know is it all comes out over a period of time. But think about the conversation that Tony started to have today, where in the last 12 months, we've had price appreciation well into the double digits. And while 2023 may not be well into the double digits, experts across multiple business, mortgage and real estate and NAR and Inman, they all believe it's going to be in the positive. And so, Mark, just speak to real estate as an investment, whether it's your primary home or your secondary home. And why is it such an amazing hedge against the inflation that we've been experiencing?
So two different questions, Gary, and I love this topic because I've been a stock investor now for probably 40 years and a real estate investor now for probably 35 years. And both obviously are good long-term strategies for wealth building. What I happen to love about real estate is that, number one, it's a tax deferred investment. Even if I cash out, in other words, if I sell it, I still get a big tax benefit, because if I'm single, I get $250,000 worth of profit, so to speak, free. And if I invest more than if I buy up, I get to roll all of my my proceeds over into a new purchase. So if I sell my stock though, I've got to pay capital gains tax on it. So I'm a huge believer in whether it's primary residence, which allows you the rollover, or even on a 1031 exchange on an investment property, I can still roll over my gain. And that compounding effect. So the first word I would use is compounding. The compounding effect of real estate by the fact that it is really either tax-free or tax deferred is a big benefit. The second thing I don't think that a lot of probably just primary or primary home investors don't look at is what I call leverage. So let's assume that I bought a $400,000 house, put $100,000 down, got a $300,000 mortgage, but then I sold it 2 or 3 years later and made a $200,000 profit. Well, it's not 200 on 500, it's 200 on 100. And I think that there's such a benefit to leverage that a lot of new people to real estate, or even people who've been in just owning their own home for a long time, don't realize the leverage factor of investing in real estate. Everybody says, well, now is not a great time to buy an investment property. I'm not so sure I agree with that at all. I think that in the real estate industry, we don't tend to practice what we preach. We say to everybody else, you ought to invest in real estate, and we tend not to do that. I think it's the perfect time to invest in real estate. Well, the interest rates are high. Okay, so you'll refi it in a couple of years. Will you be happier keeping your money? And actually, I got to tell you, I did find a place I can get 4% interest. So that's an interesting little switch. That's almost double the rate from 90 days ago. But still, it's 4% and it's taxable income to me. I'd rather put it into now, real estate's going to be more stable over a long period of time. The stock market may go up 10% next year, whereas your real estate asset may only go up 6% next year.
Right.
But it's a stable form of investment. And I'm a believer you need both. I'm a believer you need a stock portfolio. At my age, you probably need a little bit of a bond portfolio. You need a real estate portfolio. But I think it's so important that we look at real estate as an investment from the compounding and from the leverage standpoint.
Well, I think the other thing we've been talking about, and I want to chat about this a little bit, is, we talk about the interest rate if I'm a renter. And we joke that the interest rate on my rent is 100%. And so everything's relative, right? And everything's about communication. And we talk about the importance of our industry right now being a contact sport, where we have to get out and sit with our sphere of influence and have this exact conversation that we're having. I think the words we're using and the phrases and the ideas that are coming today are outstanding. But I think the most important thing is every one of the people on this call, on this Tate Talk Live, and we'll be watching it in the future, need to get out and have this conversation, because the sphere of influence is not talking about leveraging and compounding. I personally agree with Mark Bardell. I think it has never been a better time to buy an investment property, whether I'm at 6.5% or 7.5%, right? Because rents are going up at a rate of 8.5% to 9%. You're going to pay down equity. You're going to get some cash flow. You're going to pay down equity. And then I think the other point Mark brought up, I want people to hang on to, is it's not a 300 against the 400. It's what I put down against what I got out. And whether my return, Mark, to your example, is 100,000, I got 200,000. If I put 100,000 down and I got $28,000, that's a 28% return. And I just shared some other returns. So a balanced investment strategy. And we, as the trusted advisor in the real estate space, needs to lead that charge. So,
and Gary, with rent, you have a 0% return. Yeah.
Exactly.
So that's
okay, 100%
even,
return.
even if appreciation rates go as low as, some are on the bottom end predicting to 4% this time next year, that's still 4%. Homeownership wins every time, and it's a long game. Most people are going to hold on that house at least 6 years. And so the compounding, like Mark said, the effect, housing is a hedge against inflation. Most people have a fixed rate, or they have adjustable for a couple of years, or if they do, one of today's ARMs is very different than the ARMs of 15 years ago. And so while all of the other cost of living increases hit us, you have locked in your housing costs and you're making money on it, unlike remaining a renter.
Well, Stephanie, you just gave me the comment for the Ballantine sales meeting tomorrow. I'm quite confident that the interest rate on rent is 100%. And now I'm really confident that my return on that investment is 0, right?
Right.
Think about that. Home ownership rate today is 64.5%. So there's 35% of the population that doesn't own a home. And whether maybe not all of them can afford to buy a home, but there's a high percentage of those 35% that can afford a home. And they're actually paying rent under those economics that we've just shared, but they don't even know it until one of our trusted advisors gets out there. So we talked about a couple of things. Let's spend a little more time on interest rates. Those of us on this call did a little exercise a couple weeks ago, and we pretended that Tate Talk Live was actually an interview on MSNBC, if you guys remember. And we were going to be interviewed as to what's happening in 2023. And so we're going to get into some thoughts and maybe some early projections and predictions. So I'm going to throw this back to Mr. Jarrett on kind of interest rates. What do we think? And I know we all listened to an amazing, kind of perspective over the weekend. What's going to happen with interest rates, TJ?
Well, the takeaway I have from that speaker this weekend was there's only one thing that drives interest rates, period, and it's inflation. And so inflation has been running so hot, and last week's index didn't seem to cool it down, and that is driving up rates. My prediction, and this is, I almost gave up predicting mortgage rates because this last few years is kind of unpredictable, but my mindset goes to 7.5. But that was when we had that meeting 2 weeks ago, 3 weeks ago. I think it's already hit 7.5. So the theory is it will go up, and then if the Fed continues to get ahead of this inflation and can calm it down, whether it's a soft landing or whether it's a recession, mortgage rates should start dropping back again after that. I personally think we'll be in the 6s. I don't know that we'll get in the 5s, but the speaker we heard this weekend seemed to be very bullish that we were going to get back down to 5, if not a little bit lower next year, sometime in, and I think, y'all correct me, I think he said the second half of 2023. So
He said by the end of the first quarter, down to in the 4s. So he was.
That's very optimistic, and he was brought to us because he is very artful in his predictions, or accurate.
But Tony, I don't think the October inflation numbers, the CPI was not in at the time that was recorded. So that was while it was a decrease, it was a very small decrease and not what everybody had hoped for. So I'm not sure how that would change his 4s by the end of first quarter theory.
But the thing about recessions though, and I think we're in a recession, it may not feel like one because of the job growth, but on the flip side, recessions often after inflation calms down, rates will come back. I do believe rates will come back down, and I don't think it's going to be a 2 or 3 year we're going to ride. I think it will come back down sometime, but it does make me think of some of the Alan Tate mortgage words I hear, which is, date the rate and marry the house. I mean, when I first heard that, I thought, well, that's clever, that's silly. But then I thought, no, that actually makes a lot of sense because, like Mark was talking about your returns and all the leverage, all that, go find the house, because the mortgage rates is going to be a temporary thing. We're pretty bullish. Everything that here is 12 to 18 months, then refinance then. And that does make a lot of sense to me.
Gary, I think if I were going to be buying a house today, I think I'd get either a 3-1 ARM or a 5-1 ARM. I would date that rate, and 3 years is a long time for rate. I mean, interest rates, we're talking about interest rates maybe being from 7+ to maybe 6+, or maybe even as low as 5+ in the next 6 months. So I get a 5-1 or a 3-1 ARM down in the low 6s, high 5s, maybe even. Date that for a little while, and then as soon as I get comfortable with a rate that I like long-term, refinance, and I still get the house that I want.
Sandy Kim just made a comment, and I'm just disappointed I didn't think of the term, but she said, so let's start over. Date the rate, marry the house, divorce the rent. I love it. I love it, Sandy Kim. Divorce the rent.
This was all about getting some great words, some great phrases. How do we go out? And, I think the other thing, when you think about that, marry the house, date the rate, divorce the rent, add a little bit of fun into the process, right? because I think that's what we have to do. We've got to get back out with people. It's interesting. I ran some numbers this morning. As we talked earlier, if you read the media, you might think one thing. This week alone, 208 listings, 368 sales, 334 closings, just the Allen Tate Company. This month alone, through the first 17 days, 718 listings, 756 sales, and 596 closings. So, I think we have to remember that that's a lot of transactions. I think it comes out to 30 some a day. And at the end of the day, home ownership is such an important part of what we do and our quality of life. And I just think another in the chat talks about raising the equity. We pay down our debt, we raise our equity, and we get the tax benefits of home ownership and things like that. So let's shift gears a little bit. I'm a buyer, and the buyer is sitting there saying, gosh, I got interest rates are a little higher than I remember they once were. Boy, I think houses or prices are coming down. So, I'm going to wait. I'm just going to wait, right? I know prices are going to come down. Interest rates might go up. They might come down. So let's share a few thoughts on, how do we have great conversations with the buyer who's sitting on the fence, even a move-up buyer who's got a house to sell, or this first-time home buyer or renter. Share a couple of us with what are some of the conversations that they should be having with buyers that are sitting back a little bit.
First thing that comes to my mind about that conversation is first of all, what's the goal? What's the goal with waiting? Because if you're like most people, you're not able to live somewhere for free if you don't buy a house. You have the alternative is I'm going to rent. So we have to first think about what are they trying to achieve by waiting. Most likely they might be hearing some headlines that are kind of misleading and leading them to think perhaps the prices might come down, which would be a real mistake. I think, from everything that I've heard, in addition to the gentleman over the weekend that we listened to, yes, we've had a big run up on appreciation the past few years with extreme demand and low supply, historic low supply, and some of these super overheated markets, not us, but in California and Denver and Phoenix, those kind of places, they might see some give back on their prices, right? But from what everybody is saying, and nobody thinks that's happening here. So yes, Tony's point earlier, we're not going to see 21% appreciation, but I would be shocked if we don't at least get to 4% for 2023. And so you're going to lose that 4% of equity. And yes, rates are going to come down, most likely interest rates, but what have you lost and what have you given up, and how is this holding you back in your life? Because homeownership is not just about making money on your investment. It's about having a place of your own and moving on with your life, moving on up, right? And building your community and building your family. And so what are your goals? If your goal is just around money, okay, let's talk about the money. What do you think is going to happen what's going to get better if you wait? And would it actually be better? And let's talk about the real numbers as opposed to the headlines. I want to share with you guys some research I was doing to, when we talked about demystifying the headlines, I thought I would just look at some of the headlines from our own Canopy Association and what they've reported out for September numbers. And I want you to think about how this makes you feel without the perspective that is the second half of it. So the first one was inventory rose in September, increasing 32.5% year over year. That sounds very dramatic, but guess what? That brought us to a whopping 1.6 month supply of inventory, with a normal market being somewhere between 5 and 7. So that has to be playing into the psyche of people out there who are thinking they're going to see some price declines. Month supply of inventory has increased by 45.5%. Well, you read on and you learn that took our month supply from 1.1 to 1.6. month supply, which is still historic severe shortage with regard to a balanced market. So I think we have to assume that people are hearing some things that are maybe putting some misconceptions in their mind, and maybe start from what are you trying to achieve, and maybe dispel some of those myths with some of the data that Phyllis mentioned.
So I think, what comes to mind, and this is one of my favorite things to do, and everybody's probably heard this, but when you're talking with your buyers, all right, what's the best thing that could happen? What's the worst thing that could happen? And what's the most likely thing that could happen? So, if you think you're going to wait for some reason, all right, to your point, Stephanie, what are our goals? What are we trying to accomplish? Okay, so we're going to wait. So what's the best thing that's going to happen? And after you peel the onion back, I think you'll see that there's really, short of not finding the house you want to find, it's just not available right now. Why would you wait? Right. So, but you've got to help your buyers walk their way through it themselves. So I think that's always an approach you can use.
I think the other thing to think about is if obviously, as Stephanie well said, what is your goal? If your goal is a financial goal, and for many, homeownership is a financial goal. It's a way to build wealth. It's one of the best ways in our society to build wealth. But I think that an investor, so Gary's son is a financial advisor. Any financial advisor would tell you, don't try to time the market. When you feel that you need to invest, because maybe in 6 months, timing the market may work to your benefit. It may work to your drawback. But in 5 years, what decision will you have made, and what will the benefits of that decision be? So, I mean, if we tried to time the market in 2008, 2007, and say, oh my gosh, I better get out now, and then get back in. But that's such a unique skill that I certainly don't have that skill to be able to time the market, because I don't have a crystal ball. Bottom line is, if you got in the market today, would you be happy or sad in 3 to 5 years, 5 to 7 years, 7 to 10 years that you invested in real estate in October of 2022? And if you're looking at this as a long-term wealth building strategy, real estate is the best thing out there. Again, going back to that compounding and leveraging idea.
Yeah. I would also add that, what we do in this business is highly emotional. And on the buy side, maybe this is the time to lean in a little bit more on the emotions, because some buyers are pulling back because it's too crazy. It's too frenzy. I don't want to compete with 20 other people. Well, now the scripting is around, you're probably not going to be experiencing all this frenzy. So this would be a great opportunity for you to jump back in now, because you may have less due diligence, less earnest money, maybe there's some price reductions. Hey, sellers are doing these things called repairs. I don't know if y'all remember those. I mean, we're starting to see some of these negotiations. So there's some emotional opportunity to get back in the game, if you will, because it may play to your favor now. It wasn't playing to your favor. You bought some of this stuff, went high because you got emotional attachment. I got to have that house. Now it's going to be a little different.
Imagine asking the buyer from 12 to 18 months ago, how happy are you that you paid $50,000 over asking 18 months ago?
Yeah.
Whereas now, you're going to say sellers are getting realistic, buyers are getting realistic. We're approaching, some of it. So I like Stephanie's stat. They're up to 1.6 months of supply in the Charlotte market. Here in the upstate, our month supply of inventory is up 100% in the last 12 months. And we're at 3 months supply of inventory. Still a very strong seller's market, but somebody's gonna forecast depreciation when we've got 3 months supply of inventory. Charlotte, 1.5 months of inventory. Again, but it goes back to knowing your data. Yeah. And I think that's where we started this conversation to a large degree, is you got to know that data. And I'm a big believer in month supply of inventory, because that tells me the balance between supply and demand. And real estate is an economic decision. And if you know what the month supply of inventory is, and you can coach buyers and sellers to say, we are still in a seller's market. Well, then maybe I shouldn't buy it. Prices are still going up. Well, where are they going to be in a year? Because we don't ever forecast right now in our lifetime. I don't know that any of us will see depreciation.
Yeah, let me add to that, especially around the data and the stats. Not only do you know it, you need to run it more often. This market is changing very quickly in certain price points, certain areas. And like Stephanie was talking about, your seller sold the house for 20 offers 2 months ago. Well, that market's gone. Now this market is totally different. You got to, and we get to do those seller reports every week like we used to do in the old days. You know, we got to bring that stuff back and be more frequent with the review of it.
So it's interesting, we talk about inventory, so we're going to shift gears a little bit. And a couple of observations. One, as mentioned, Charlotte, 1.6 months, upstate, 3 months. Here's what we all know, that the real estate market is interesting because it's global and hyper local at the same time. And what's critically important, even here in Charlotte, where Stephanie and I are, we could go to a subdivision. I'm just going to pick on Piper Glen. Piper Glen was 700 plus houses. They've got 5 or 6 unique subdivisions within the subdivision. You can't answer a question about Piper Glen. You have to answer a question about the greens. You got to answer a question about Links Drive. And I think, you know, it's this data that we've been talking about. And, you know, when we think about MSI, months supply of inventory, I know that this team believes in 2023, that is a data point that we encourage everyone to know chapter to verse each and every day. We talked about, as we prepared for our MSNBC interview, what was happening to inventory. And it was no surprise. And again, Katrina's not here today, but every one of the RVPs came back and the number was the month's supply of inventory. Because what we know is 6 months is the equilibrium. Like 6 months is when we shift from buyer to seller. And so if we know that, and again, keeping current matters provides a tremendous number of infographics really on a monthly basis that you can apply into knowing that information. So let's talk about inventory. I think that Mark and I, interestingly enough, in the town hall, we were asked about inventory and Mark gave an answer and I gave an answer and they were so totally different. But I think that's probably because we don't have the crystal ball. So let's go around the room a little bit here. And what do you think is going to happen, whether you call it inventory or a month's supply of inventory in 2023? Phyllis, what are your initial thoughts about that and go forward?
Yeah, so most of our markets, so Triangle, Charlotte, Triad, I think are at somewhere between 1.5 and 2. Mark's market, upstate a little bit more than that. I'm not expecting a big shift. So I'm expecting, you know, we'll go up to 2 to 2.5, maybe month supply of inventory, which again is very much a seller's market, right? But I don't think we're going to see a huge shift because for a lot of reasons, but we won't do all that. But that's my prediction. Not much of a shift.
Yep. PJ.
My prediction would be we're going to get closer to 3 months inventory supply based on what I'm seeing. We had the Triad, the Triangle, the High Country regions consistently across the board. We were getting a lot of new listings up until that June. I mean, a lot of new listings coming in. And the Triad especially, I was like, ooh, this is going to be fun. We're getting listings back. And then around July, it stopped and it started shifting the other way. And at the same time, sales slowed down. So now it looks like we have a lot more inventory. We don't have a lot of new listings. Our inventory has grown because the buyers have slowed down. That's what's shifting the MSI. And that means pricing becomes even more and more critical for the seller and the buyer start looking for the opportunities. But my prediction is when we go into the first quarter, second quarter next year, I don't think we'll get to 4 months, but I think we'll get to 3 unless the new listings start turning. If the new listings, then we're in a different arena.
So Tony, real quick, based on your analysis, which I think you're spot on, is all the more reason as we are consulting with sellers that your house has to be the best one on the market.
Yeah.
You've got to invest in the paint and the carpet and the declutter and the landscape. And you know what's going to come back? Home warranties are going to come back, right? We just saw in our chat room a contingency with a builder. Can you imagine? We're going to go back to a home warranty. I mean, that seems like it was prehistoric. You know, because we were non-contingent, waive this, waive that. And the beauty is everything we're talking about, everyone who was in the business, 17, 18, 19, has done it over and over and over again. So TJ, thanks. Stephanie, inventory months supply.
Okay, so I think I might have revised my thought process since we last talked about this because of two things that I've been thinking about. The first is the fact that I think it was Marcy Rosell in one of her leading real estate companies of the world, Economic Updates. She said something that sort of resonated, and she said, this is a temporary interest rate driven pause in the marketplace that is this inflection point we're experiencing. And the reason why she thinks it was temporary is because she said when a consumer realizes that the rates are not going to continue to move and they are where they are for a while, they will jump back in the market. If they took a pause because of the uncertainty and they know rates are not coming right back down, which I think with last week's October CPI, everybody probably realizes that's not going to happen like next month, right? So we're probably going to see another 75 basis points raise in the short-term Fed fund rate. And so that's going to keep us elevated for a while. So my prediction is that we are going to start to see some buyers who maybe took that pause button because of the uncertainty and, well, gosh, I don't want to lock on this rate if it's going to come right back down, right? So I think those guys are going to come back in the market sooner than later because of all the things that we're talking about, because hopefully they're being well educated by their Allen Tate realtor. But the other thing on my mind that Mr. Habib talked about this weekend is I think this, for the first year in 3 years, we have just seen a seasonal adjustment in new listings, what Tony just talked about. I think April, May, June, all those new listings that we thought were kind of just market driven were probably just our normal seasonal adjustment, parents trying to get the move done prior to the school year starting. So I'm not so sure that plus the buyers that I predict are going to jump back in now that we know interest rates are probably even going to go higher before they come down. I think those two things are going to keep the month supply of inventory under 3. That's my new prediction.
So the other thing about having interviewed on MSNBC is prior to the airing, you're allowed to modify your projection, because I think
good.
my guess is we all have. I know I've changed every one of mine since I've talked to a lot of people that are way smarter than I am. But, I think that it's really important for us to think about these things. And we talked about it this past week. Real estate professionals have a tendency when they think about the next year, we're just going to do more. I'm going to do 10% more. I'm going to do 5% more. And we really think it's important to understand what the market's going to do. And then how am I going to compete in a market that it looks different than the market was? We're going to sell 5 million existing homes in 2023. We're going to sell a lot of houses, right? It may not be the 6.1 we sold in 21, but it's going to be a boatload better than the 4.2 we sold in 2010. And I've shared this data over and over. From 2012 to 2019, we averaged 5.2 million existing homes. And a lot of people have been really, really successful. I did share this piece of data back in 1983 when the interest rates were 18%, 2 million homes were sold. So just think about that for a minute, right? Home ownership is a really, really important thing in our lives. And we've all said that. And to think about in 82 and 83, back when Mark and I were, getting started in the real estate business, that was a little bit of a joke. But, interest rates, we're talking about 7.5%, 8%. And 17, 18, 19, or 16, 17, 18% selling 2 million homes. So Mark, month supply of inventory.
So Stephanie stole a couple of my words that I was planning to use, but seasonality. If we go back to just the normal market that we've all been accustomed to for the majority of our careers, listings tail off in the wintertime. Natural seller behavior. I don't want my house to be on the market between Halloween and New Year's. It's not what I want. I don't want my house shown during the holidays. Seasonality. Then what happens in January? We see listings coming on. We see buyers want to get in, they get in the spring market, that proverbial spring market, because I want to move in the summertime, because I don't want to move my kids during the school year. Seasonality. But I think that that's going to play in our favor, because if the interest rates remain high through the low season, it will have less of an impact on our sales than as if the interest rate suddenly spiked up in March, April, and May of next year, which I think would have a more dramatic impact. We've mentioned several times this video from this guy that we watched, and I'm going to implore everybody on this call. Your branch leaders have the link. It's by an economist in the mortgage industry named Barry Habib. He explained so much in 35 minutes. And here's what I learned about inflation, and here's why I'm not worried about interest rates. The reason that the CPI ticked up way high on the most recent reading is that the way CPI is calculated is you drop off the 13th month and you add the most recent month. Well, the 13th month last year was 0.02%. We're going to drop off October of this year. Well, October last year was 0.06. So I actually think that the CPI index, when it's released in early November, is going to show a very insignificant increase in the inflation rate because of the fact that we're dropping off a really high month last year and adding what is probably going to be a pretty insignificant number this year. So my prediction is that month supply of inventory will grow slightly through the winter, but then that seasonality will kick in. We'll see more listings, but we'll also see more sales. And like everybody on this call, I predict less than 5 months of inventory, which would still keep us in a seller's market. And I think that that's much healthier than the 0.5 to 1 month of inventory that we've had for the past 2 years, which have contributed to this rapid appreciation. And there's one more number we haven't talked about, which is the affordability index. And the fact that America is in a really bad spot with affordability index. If we, to use Tony's comments, if we decelerate our appreciation, we will improve our affordability index. And I think that that's critical to our society. So I'm with everybody on the call, of course. We're going to remain in a seller's market, I think, for the foreseeable future. But I do think that it will be a calmer market at 3 to 4, in some markets, maybe 5 months of inventory.
Perfect. I agree with all of the above. So we have 4 minutes left. So I'm going to go around to our panelists and let's give our viewers kind of your one thing, your one piece of advice as we continue in the fourth quarter of 2022, as we begin to business plan and strategize for the marketplace that we all expect to see in 2023. Just go around and share the kind of the one thing. And if you want to violate one thing and give 2 things, we're not going to hold that against you. But let me start with, I'm going to start with Phyllis. What the best advice you can give today to our viewers?
Well, I think we've talked about it several different ways, but make a commitment to understand the market and be able to articulate and explain and educate about it, whatever that means. So I'm a big believer in, I always talk about having a meeting with yourself each week to set yourself, think about what's coming up. During that meeting with yourself, you need to be learning the market and understanding it from a lot of different points of view. So make the commitment, write it in ink on your calendar, find your sources where you're going to get it from. We've given you lots of examples today, and make that commitment. We were talking about, people asking you the questions. I was getting my nails done this weekend, and she said she knows I'm going the same place. She knows what I do. And she's like, so I understand spring is going to be the best time for buyers. And I was like, oh my God, getting my nails. Can we not talk about real estate? But you got to be ready. You got to be ready. And then I said, I'm going to text you later and send you some links. So I've got some of those KCM slides that I have ready to send people. So be ready, invest the time to make sure you're ready to talk about it.
Beautiful, beautiful, beautiful. TJ.
The market has shifted. Are you shifting with it? So you think about the agents who started in 08, 09 are some of the best agents in the business because they knew how to weather storms. This storm is not as significant as 08, 09, but it's still a storm. So are you not just shifting what we've talked about today, which is staying on the market and knowing the market, but are you shifting your prospecting? Are you looking at different? The good news, the prediction is that we're going to see a decrease in realtors. So I think we're going to have a less competition out in the field. It's going to happen next year, but what an opportunity for you to grow your business. So just make sure you're shifting as well.
Awesome. TJ, great job. Mr. Bordeaux.
2 words: consistent And I think that if you're consistent in your marketing, you will thrive in this business. If you're patient and don't react to the next shiny ball, I think that you're going to thrive in this business. And I learned both of those when I was getting my toes done this weekend.
That's a
another
good
line of the
visual,
day.
Mark.
Yeah, that's a great visual.
Am I without a word, but it's hard for me to even ask Stephanie to go because I'm kind of thinking about that. But Stephanie, your words
So,
of wisdom for us.
Yeah, I mean, I was gonna say, I was gonna talk about mindset, but I think the better way for me to explain what my piece of advice is to say, know that know every day that you are a thought leader in this market. As an agent at the Allen Tate Company, you are a thought leader. People are looking to you for your counsel and for your advice. Take advantage of your position and make 5 connections every day and ask people if they have any questions about what are going on. I promise you 5 out of 5 will say, what is going on? So be a resource. It's a great opportunity to reach out to your sphere. And, the second thing so that was just really one, Gary. My second thing, you said I could have 2, is to lean on, this is the time that we need our Allen Tate mortgage partners more than ever. Please lean into that relationship and let them help you have some high level talking points that you don't get too much in the weeds with your buyers because you're not that expert, but set them up to help you counsel folks and at least have some high level talking points so that you could talk about some options like these guys referred to today with folks who maybe want to try to do something temporary with a rate so that they can buy now. Be it an ARM or be it a 2-1 buy down or fill in the blank, but know the basics of that, because I think we can't assume that many of our realtors have really been in a market that needed to know about that. So just kind of retooling on that, I think, is pretty important.
Awesome. Well, we are wrapped up. I got 2 words on my advice, and one is leverage and the other one is fundamentals. And leverage means tools, resources, people, family of companies, leaders, colleagues. Leverage the resources that we all have around us. And fundamentals. What we talked about today were the basic fundamentals that many of us have done many times over the years. We just got out of a little bit of practice because the market was what was creating the energy around interest rates and the response of COVID-19. So I want to say thanks to Phyllis, Tony, Mark, Stephanie. We missed Katrina. And so clearly she will be doing a solo Tate Talk Live in November, and she's going to run a panel and she will be asking questions and she'll be answering them. And according to Katrina, it will be fast paced because she talks rather quickly. Just kidding. We are going to have an agent panel November 9th I think it's November 9th for Tate Talk Live. And again, thanks for joining us. Have a great rest of your week. And we will put this link on Friday and Tate University. Take care.
Bye, everybody.
Right.